In Chapter 2, we talked about financial statements, and in this video, we're going to build a balance sheet and an income statement. So to prepare a balance sheet, we're going to prepare a balance sheet for Dorman Incorporated as of December 31st, 2019, based on the following information. And you can see we have cash, patents and copyrights, tangible net fixed assets, inventory, notes payable, accumulated retained earnings, and long-term debt. So we're going to start with assets, and remember that we're going to list those in order of liquidity. So the most liquid asset is going to be cash. So that's $305,000. And I like to just mark them off as we use them to make sure we've taken care of everything. Now, the only other current asset is going to be inventory. And that's $249,000. We'll mark that off, and we're going to add these together so that we have our total current assets. $554,000. Now we're going to list fixed assets, and our tangible net fixed assets are $5,168,000, and our intangible net fixed assets are $745,000, and we will total these. So our total fixed assets are going to be $5,913, and when we add our total current assets to our total fixed assets, our total assets are $6,467,000. So our right-hand side, our liabilities and equity, have to equal this number as well. So we've done the patents and copyrights are our intangible assets, and our tangible net fixed assets. So we've done all of that. So now we have notes payable, long-term debt, and accumulated retained earnings left. So our notes payable is what we will have to pay within the year. So it is our current liability, $213,000, and that totals our current liabilities. Then we have long-term debt, and that is $1,533,000. We'll mark these two off. And for some reason, they don't often total the liabilities. We just move right on to the equity. So I'm going to leave a spot here because this is for our common stock and paid in surplus. And then our accumulated retained earnings. And they are going to be $4,862,000. So when we total our total current liabilities, our long-term debt, and our accumulated earnings, retained earnings together, they do not total our total assets over here. And remember, with the balance statement, the total assets, the total assets must equal total liabilities plus equity. So we have a gap here that we need to fill. So if we take the $6,467,000 and we subtract our total current liabilities and our total long-term debt, and finally the accumulated retained earnings, we have $859,000, which is going to go here for our common stock and paid-in surplus. Now, when we add these four numbers together, we get $6,467,000, and our balance sheet balances. Now we're going to build the income statement. Still using Dorman Incorporated. They have revenues, cost of goods sold, depreciation expense, interest expense, and a 21% tax rate. So first we're going to calculate the net income, and then we're going to calculate the operating cash flow. So we have to set up the income statement. And when the income statement uses the formula revenues minus expenses equals net income. So our revenues are $635,000, and our cost of goods sold are $350,000, and then we will subtract our depreciation, which is a non-cash item, but we subtract it because it gives us a tax break. And when we subtract cost of goods sold and depreciation from our revenues, we have earnings before interest and taxes, or EBIT, of $310,000. Now we're going to pay our interest, so we'll subtract the interest expense of $29,000, and we have earnings before taxes at $281,000, and now we're going to pay our taxes. And to get our taxes, we would do the $281,000 times 0.21%, or 0.21, which is 21% tax rate. It's $59,010. So we subtract the $59,010, and our net income is $221,990. So now we're going to find the operating cash flow, which is EBIT. We're going to use this formula, plus depreciation back minus our taxes. So our EBIT was $310,000 plus depreciation of $75,000 minus our taxes of $59,010. And when we do the calculations there, we find our operating cash flow is $325,990. Now, sometimes you may have a net loss, but you'll have a positive operating cash flow. And that could be that the depreciation, the interest, could make your earnings go below zero, which would cause you to have a negative net income, but you would actually still have a positive operating cash flow.